We have all been sold the exact same American dream since 1950. Buy a house, build equity, and get rich. Renting? Society tells you that is just throwing money away into a bottomless pit. But in 2025, that conventional wisdom is not just mathematically flawed, it is actively destroying your wealth. Let us look at the brutal, unvarnished math. You decide to buy an average $400,000 home today. You put down 20%, which is $80,000, and you secure a standard 30-year fixed mortgage at 7%. Sounds completely standard and responsible, right? Now let's open up the hood on this loan. Over those 360 months, you will obviously pay back your original $320,000 principal to the bank. But here is the shocker. You will also pay a staggering $446,000 purely in interest. Yes, $446,000 in pure interest going straight to JP Morgan or Wells Fargo. Mathematically, you are buying one $400,000 house for yourself to live in, and you are buying a second, even more expensive, $446,000 house entirely for the bank. And that is before we even talk about taxes, maintenance, and insurance. Your liquid cash is trapped, and your future income is collateralized. Welcome to the 30-year debt prison of the modern housing market. Let's break down exactly how this wealth extraction engine works against you. Why did your parents swear that real estate was the ultimate wealth builder? Let's look at historical data. The truth is, they played a completely different macroeconomic game than we do today. Back in 1990, the median United States home cost roughly $122,000. During that same time, the median household income was about $30,000. This meant a house cost roughly 4 times an average annual salary. Very affordable. Now let us fast forward to today. That same median home is pushing $420,000. Meanwhile, median household incomes have stubbornly stagnated, only reaching around $75,000. The price-to-income ratio has completely decoupled, jumping to nearly 6 times the annual salary. Furthermore, consider the interest rate environment. From 1981 to 2020, rates did only one thing. They dropped from a historical peak of 15.8% all the way down to a bottom of 2.6%. Our parents bought fundamentally cheap assets in a steadily declining interest rate environment. This massive macro tailwind naturally inflated asset prices over 30 years, making them look like investing geniuses. But in 2025, the game has fundamentally flipped. We are buying at peak historical valuations, and we are fighting a brutal 7% interest rate headwind that suppresses purchasing power. The boomer financial playbook is officially dead. You cannot use 1990 rules to win in 2025. Let me introduce you to the banker's greatest invention, the amortization schedule. When you pay your $2,128 mortgage this month, you feel proud. You think you own a little more of your kitchen. Look at the data. In year 1 of a 7% mortgage, a massive 83% of your monthly payment goes straight to interest. Only 17% touches the principal. Fast forward 5 years into this loan, you have paid the bank $127,000 in hard cash. But your actual equity, the part of the drywall you actually own, has only increased by $19,000. If you get laid off and are forced to sell before year 7, the 6% realtor transaction costs alone will completely wipe out every single dollar of equity you built. You are officially underwater on this loan. The bank engineered it this way on purpose. You are barely paying down the principal. But what about the other hidden costs? We call this the iceberg of home ownership in financial modeling. The mortgage payment is just the tip of the iceberg that you can see. Below the waterline is a massive, crushing block of unrecoverable sunk costs. Property taxes average 1.1% nationally, meaning $4,400 a year, that vanishes into government coffers. Homeowners insurance is skyrocketing due to climate risks, easily adding another $2,000 annually. Then there is maintenance. The golden rule of real estate is reserving 1 to 2% of the home's value for repairs per year. Let's be conservative, $4,000. Add in HOA fees, and suddenly your $2,128 mortgage is costing you $3,200 a month in pure cash outflow. And not a single penny of those extra costs builds your net worth. Here is the ultimate paradigm shift that wealthy investors truly understand. Rent is the maximum you will pay for housing every month. A mortgage is the minimum you will pay. When the HVAC unit unexpectedly explodes in July, the homeowner writes a massive $6,000 check. But the renter simply makes a 30-second phone call. But to win as a renter, you cannot just rent a luxury apartment and blow the difference on vacations and Rolexes. You have to rent and invest the difference. This brings us to the ultimate 30-year financial showdown. Let me introduce you to our two case studies. First is buyer Bob, and second is renter Rick. Both men are exactly 30 years old. They both have the exact same income and savings. Both have exactly $80,000 in cash ready to deploy. Let's see how their different choices compound over 3 decades. Bob takes his $80,000 and uses it as a 20% down payment on the $400,000 house. Factoring in the mortgage, taxes, insurance, and maintenance, Bob's total monthly housing cost is exactly $3,200. Rick decides to rent an identical house 2 streets over. Because rent yields are currently significantly lower than mortgage rates, in most major U.S. cities, Rick rents the exact same floor plan for $2,400 a month. Right out of the gate, Rick has an extra $800 in his checking account every single month compared to Bob. Furthermore, Rick never spent his down payment. He still has his original $80,000 sitting in cash. Bob's capital is locked in drywall. Rick is fully liquid. What does renter Rick do? He acts like an institution. He stops thinking like a traditional consumer and starts operating his wealth like a major bank. Rick immediately deploys his $80,000 into a low-cost S&P 500 index fund like Vanguard's VOO. He also sets up an automatic brokerage transfer to invest that extra $800 every single month. This is the pure definition of opportunity cost, the compound return you sacrifice by locking your liquid capital inside an illiquid asset like drywall and bricks. Historically, since 1957, the S&P 500 returns about 10.2% per year. Real estate, historically tracked by the Case-Shiller Index, appreciates at about 3 to 4% a year, barely keeping pace with inflation. The stock market is a hyper-efficient wealth creation engine driven by human innovation. A house is a depreciating physical structure, sitting on a potentially appreciating piece of dirt. Let's jump forward in our financial model to the 10-year mark. Bob is now 40 years old. His house has appreciated at a steady 4% a year. It is now worth $592,000 on the open market. He has aggressively paid his mortgage and now owes $272,000 to the bank. His net worth tied up in the house is $320,000. Not bad at all. He feels like he is winning. But let's look at Rick's completely different trajectory. Rick's original $80,000, compounding at 10% in the S&P 500, has passively grown to $207,000. His $800 monthly investments have compounded into another $163,000. Rick's total liquid stock portfolio is now exactly $370,000. Rick is actually beating homeowner Bob by $50,000 in pure net worth. And crucially, Bob's net worth is trapped in illiquid housing equity. Rick's net worth can be liquidated in a millisecond on his phone. At the 10-year mark, the renter takes a slight lead. But the real financial magic happens in the next decade. In year 11, the mathematics turn absolutely brutal for Bob. Bob's house is appreciating on a slow, linear path, constantly hindered by relentless maintenance costs and property tax hikes. Meanwhile, Rick's stock portfolio is hitting the steep part of the exponential curve. This is the magic of compound interest at work. Rick isn't just earning 10% on his original money anymore. He is earning 10% returns on his previous 10% returns. Let's fast forward another decade to year 20. By year 20, Bob has built $625,000 in total home equity. And Rick's Vanguard portfolio? It has exploded past $1.1 million in liquid assets. The wealth gap isn't just widening linearly anymore. It is tearing apart at the seams. Rick is officially a millionaire. There is a massive hidden cost to Bob's house that no amortization schedule shows. The death of career mobility. Back in year 5, both Bob and Rick were offered a promotion in another state with a massive 30% salary bump. Rick simply broke his apartment lease, paid a standard 2-month penalty fee, and relocated immediately to take the higher salary. Bob, on the other hand, could not. Selling a house typically takes months of preparation, and the standard 6% realtor transaction fees would have completely erased his entire home equity. Bob had to decline the promotion. He was anchored to the ground. In the modern 2025 economy, human capital, your ability to rapidly increase your income, is your greatest asset. Buying a house in your 20s or 30s effectively short-circuits your career velocity. Year 30, Bob is 60 years old and throws a mortgage burning party. He owns his home outright, and it is now worth $1.3 million. He feels rich, but renter Rick's stock portfolio, fueled by the initial $80,000 and 360 months of $800 investments compounding at 10%, has reached a staggering $3.1 million. Rick is a multi-millionaire. Using the Trinity Study's 4% safe withdrawal rule, Rick's portfolio generates $124,000 in passive income every single year. Forever. That is more than enough to rent a luxury penthouse in almost any city in the world without ever touching his principal. Bob is house rich, but cash poor. Rick is just rich. Real estate agents will angrily tell you that a fixed mortgage hedges perfectly against inflation. They argue your payment stays perfectly flat while rents go to the moon. This is completely true. Over 30 years, Rick's rent definitely increased every year. But this simplistic argument completely ignores a fundamental reality of the market. The businesses that make up the S&P 500 also raise their prices. When inflation hits, companies like Apple and Procter & Gamble charge more. Equities are actually one of the greatest inflation hedges ever. Let's be ruthlessly fair and adjust Rick's rent upwards by 3.5% every single year. Because his rent goes up, his extra monthly investment capital shrinks mathematically. But even with smaller monthly contributions, the sheer dominance of 10% compounding absolutely obliterates a 4% appreciating asset. Furthermore, Bob's housing costs were never truly fixed anyway. His property taxes and home insurance inflated heavily every single year too. A mortgage only fixes the bank's portion, not the government's or nature's. When you factor in total inflation, renter Rick still mathematically destroys buyer Bob. Let's be objective as financial analysts. Is buying a house always a mathematical disaster? Absolutely not. Buying makes sense under 3 strict conditions. First, you plan to stay in the exact same location for at least 10 years. This allows you to properly amortize the massive transaction costs. Second, the price-to-rent ratio in your specific city is strictly below 15. This mathematical metric simply means homes are actually cheap relative to rents. Third, you have a fully funded 6-month emergency cash fund. And crucially, That is, after you have paid your 20% down payment. Buying a home should never be viewed as your primary investment strategy. It is fundamentally a lifestyle consumption choice. You buy a house because you want to knock down a wall, paint a nursery pink for your firstborn child, and adopt a golden retriever with a backyard. You make this purchase for stability and utility, not because you secretly expect a box of wood to beat the market. Here is the ultimate catch to everything we just analyzed. The $1 million renter strategy only works if you possess the ruthless discipline to actually invest the difference every single month. Statistically, most people do not. A 30-year mortgage essentially acts as a forced savings account for everyday people who lack that kind of strict financial discipline. If you decide to rent and you take that extra $800 a month and use it to lease a luxury BMW M3 and buy overpriced designer clothes instead of investing it, Bob the homeowner will absolutely destroy you financially over the next 30 years. The opportunity cost math we calculated is completely foolproof. But human psychology and behavioral finance are incredibly fragile. To actually win as a renter in this economy, you must treat your monthly Vanguard index fund contribution with the exact same absolute non-negotiable obligation as a ruthless Wall Street bank treats a monthly mortgage bill. Wealth in 2025 is no longer about how many bricks you own. It is about liquidity, compound interest, and cash flow. Renting is not throwing money away into a void. It is buying maximum flexibility and preserving your capital for higher yielding asset classes. Do not let society or real estate brokers shame you into a 30-year debt trap just to fulfill an outdated dream that officially died in the late 1990s. Master the math, invest the difference relentlessly, and buy your absolute financial freedom instead. If this rigorous financial breakdown changed your perspective, hit the like button and subscribe for more Wall Street level analysis. Share this with a friend who is about to sign a 7% mortgage. Drop a comment below. Are you team buy or team rent in 2025? This video is for informational and educational purposes only, not financial advice. All investing carries risk of loss. Do your own research and consult a licensed financial advisor before making decisions.